ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን
Okay, good afternoon. Welcome to this class. Today we'll start the course Financial Management, and the course code is 622 and it is 2 credit hour. And the content, I hope you all have the course outline and PowerPoint together with books. And this is the content of the course. The first chapter deals with overview of financial management. The second chapter deals with the second chapter deals with capital budgeting decisions. The third one, financing decision, capital structure, and cost of capital. The fourth chapter, working capital decision. The fifth one is dividend policy. And these chapters are interrelated, and the course is designed in line with basic financial management decisions. The first chapter is overview. The second chapter is capital budgeting decision. It is the first decision, first financial decision. We have to decide where to invest. And then we have to decide the source of finance, financing decision, and capital structure. And after accessing finance, we have to manage our working capital. And at the end of the period, we have to decide what to do with the generated cash, whether to divide or whether to pay it in the form of dividend or to retain it. So these are the contents to be covered. Regarding assignments, article reviews and cases will be there, and I will forward those articles and cases. The review guideline is attached together with the course outline. You can find it from the course outline, the review guideline. I'll forward articles and cases. And regarding the exam, it will depend on the situation. Okay. Let's start the course. The first chapter is with an overview of financial management. And in this chapter, we will see some basics in financial management, its definitions, basic financial decisions, principles in these financial decisions, agency problem, time value of money, and the likes. We'll see these issues in the first chapter. Simply, it is an overview of financial management. But to begin with, let's define finance, because financial management is within finance. What do you mean by finance? And usually, the students get confused with the difference between accounting and finance. But they are completely different, but they are related. Finance, we can define finance in different ways. We can define it like analytical tool for money and the market. Finance is an analytical tool for money and market. It is concerned with resource acquisition, allocation, and management. Or it simply means the study of how to invest and raise money productively. So it is the issue of accessing finance and the issue of using it in a productive way. Finance. But within this, in this process, for example, to decide where to invest, it is not an easy decision. We have to understand the process. We have to understand different issues, macroeconomic, microeconomic issues. We have to understand the profitability and the attached risk. So we can decide where to invest. After deciding where to invest, we have to arrange the source of finance. This accessing finance is not an easy decision as well. We have to understand the market at large, the financial market, institutions, instruments, process, and the likes. So this is complex. The issue of raising money and using it in a productive way is a complex process. So finance is the issue of how to raise money and how to use it. We can define finance like this. It uses accounting information as an input for decision making. For example, if our company is interested to access finance from a bank, we have to submit financial reports so that the bank will assess our performance and predict our future performance too, assessing past, current, and predicting future performance. And the bank will have some understanding about the creditworthiness of our company, so that the decision will depend on the information provided. So accounting information will be used in financial decision. Even at company level, at the time of deciding where to invest, we have to get accounting information. This projected cash flows, projected income, projected assets, and related issues must be available. So we can decide accounting information. We can use accounting information to decide where to invest. So accounting information can be used for financial decision. We need accounting information to decide how much to distribute to owners in the form of dividend. So accounting information will be used in financial decisions. And another thing that we have to know is finance is constantly changing, because finance has macroeconomic implications. So macroeconomic factors will affect financial decisions. So financial decisions require macroeconomic issue understanding, the inflation, deflation, the foreign trade, foreign currency, exchange rate, the macroeconomic stability, and others. These all will affect our financial decision, from where to invest, how to access finance, how to manage our working capital, how to pay dividends. These decisions will be affected by the macroeconomic issues. And as you all know, the macroeconomic issues currently are changing. So we have to know that finance is constantly changing. Oh. Okay, let's see areas of finance. Areas of finance. As I've said previously, financial management is one area of finance, and there are also other areas of finance. Let's see financial management. It is one area of finance. We can call it also corporate finance, or we can call it business finance as well. We can use these terms interchangeably. Financial management, corporate finance, business finance. How can I disable this? Sorry. Okay. Financial management or corporate finance, it is financial decision as applied at corporate level. I think I have to close. Okay, financial management or corporate finance is finance as applied in business organizations. So business organizations are concerned with how to raise money and how to use it in a productive way. Investment decisions, financing decisions, working capital decisions, dividend decisions in the business organization context can be referred as financial management. Financial management. And there is also another area of finance, investment. It works with financial assets such as stock and bond. We call this financial assets. By the way, the most difficult thing to teach and learn in finance courses in our country is the absence of financial market. There is no financial market, a market in which financial instruments are traded. Financial instruments including stock, bond, other short-term securities too. There is no market. But when you say investment decision in this case, purchasing shares of another companies from the market, from the secondary market, maybe from the primary market, purchasing corporate bond or government bonds. It is investment. If you purchase shares, you are investing. So investment decision works with financial assets. Identification of those potential investee companies. That means identifying the shares, company shares, analyzing their profitability and related risk, selecting the appropriate ones. That means forming a portfolio. These are activities in investment decisions. So investments relates to the acquisition and sales of stocks. Actually, when you invest, we are purchasing it. After purchasing, we will sell it. So they are related. So financial institutions, these are another area of finance. When you say financial institutions, maybe depository, maybe non-depository. In our country, there are banks, for example, insurance companies, microfinance institutions, banks, depositories. They accept the deposit. Insurance companies, non-depository. In a country with financial market, well-developed financial market, there are different types of institutions. For example, investment banks. They support companies at the time of issuing shares or at the time of issuing debt instruments, bond. To issue share, companies can consult with investment banking firms. And they will purchase and sell shares in the market. As I've said previously, there is no secondary market in our country. So the investment banking business is not available, or there is no, you can call it. So when you say institutions, there are formal financial institutions engaged in financial service, including banks, insurance, microfinance institutions, investment banking firms, and others. International finance, overseas business. So when you say finance, there are different areas, but they are not mutually exclusive finance areas. They work together. For example, as a manager in a single business organization, you will engage in investment decision. You will purchase shares from the market, and you will work with financial institutions as a borrower or as a buyer of their instrument, and you will be engaged in international finance. So they work together. These finance areas work together. So as a manager, you have to know these areas so that your financial decision will be effective. What are those financial decisions? Financial decisions, financial management decisions. We can classify these financial management decisions into three. The first one is, which assets should we invest in? Investment decision or capital budgeting decision. We'll see these issues in the next chapter, chapter 2. So this is one area of financial decision. Which assets should we invest in? If we are forming or if we are organizing a new business, what type of business is profitable? A manufacturing, a service, or other? If we are purchasing share of a company, we have to identify where to invest. So this is the first decision. We'll see it in chapter 2. After investment decision, financing decision will follow. How will we pay for those assets? Once we decide the type of business, once we identify a project, we have to arrange the source of finance for that project. This is what we call it financing decision. There will be long-term source of finance, maybe by selling the company's shares or by selling debt instruments, bond, if the country's regulatory body allows that, allows corporate bond, we can sell bond. In our country, there is government bond, and only governmental institutions issue bonds in the country. So, but if the financial system is well developed, and if the regulatory body is strong, if the market is established, it will be possible to sell different types of instruments. No need to go to a bank to access finance. But in our country, debt market is limited. It is bank dominated. We have to go to a bank to access long-term source of finance for our business. Otherwise, other source of debt financing is very limited. But if there is market, it will be easy to sell our corporate bond. We can sell share. If the share is not enough, we can sell debt instruments. If that's not enough, we can sell different types of instruments. We'll see these types of instruments in chapter 3. And once we identify our source of finance, we have to start working, operation. In the day-to-day operation, we have to balance our cash and our short-term obligations. That means we have to purchase, for example, input. We have to pay for material if it is a manufacturing company. We have to pay for labor. We have to pay for overhead. These are short-term obligations. So the cash available must be enough to cover these short-term obligations. This is what we call it working capital management. If the working capital management of our company is poor, if there is no cash to purchase raw material, for example, there is no operation. If there is no operation, there is no sales, the company will be at loss. So the company will face a difficulty to pay short-term obligations and to pay its borrowed fund with interest. Simply the company will cease to exist. So working capital management is critical. So we'll see these financing decisions in chapter 3 and chapter 4. Chapter 3, long-term source of finance. Chapter 4, working capital, short-term source of finance. So arranging our cash or balancing our cash and our short-term obligations. And the last chapter, the last decision is dividend decision. Once we operate smoothly and generate cash, we have to decide how much to distribute to owners and how much to retain. This is what we call it dividend decision. So these are major decisions: investment decision, financing, both long-term and short-term, and dividend decisions. So we'll see these issues. So let's see the function of a financial manager. Function of a financial manager. Assume there is an organization. The organization is here, the operation. The operation or the organization that is managed by group of managers. There is an organization simply. And there is a market, financial market. As I've said previously, in our country, there is no secondary market. When I say financial market, there are markets different types of markets. We'll see those markets. There are institutions, different types of institutions, banks, insurance companies, microfinance institutions, and others. There are also instruments that will be traded. So simply there is a financial market. There is your business or operation. The financial manager's duty will be raising fund first. Investment decision is internal decision. After investment decision, the financial manager will access finance from the market, maybe by selling stock or shares. The term stock stands for shares, in Amharic, action. And usually in our country, since there is a British accounting influence, stock stands for inventory. But here, when you say stock, we are referring shares. Don't get confused. Shares, company shares. Or debt securities. Debt securities by selling bond, for example, corporate bond. If the company issues bond, the company is borrowing money. But in our country, for example, there is corporate bond, government bond, the Renaissance Dams bond. The government is selling the bond. That means the government is accessing finance for that project. So the government is a borrower. So in our company, financial managers will sell stock or bond to investors. Investors may be individuals, may be institutions. For example, if you are buying a share of a bank, you are investing in that bank. Or institutional investors will be there. So we can sell shares. We can sell shares. These are obligations. If we sell shares, we'll have future obligation to pay dividend, and owners will have interest on assets of the company too. So there is obligation. If we sell debt securities, corporate bond, the obligation is in the future we have to pay the principal plus interest. So obligations are there. So cash will be received, obligations will be attached. So there is a certificate for those obligations. Stocks, debt securities. They are certificates. So we can receive, we'll receive cash, and we have to provide buyers stock or debt securities. And then we'll invest it. We'll do business, that means. After that, after doing business, the business will generate cash. Will generate cash. And financial managers, in consultation with the management, will decide how much to reinvest in the operation, and how much to pay in the form of dividend, or how much to pay to investors. If it is stock, we have to pay dividend. If it is debt instrument, bond, the bondholder will receive interest plus principal. So this is the function of a financial manager: accessing money, issuing securities, investing that, and that investment will generate cash, and that cash, some portion will be reinvested again, and some portion will be paid in the form of dividend. So these are activities. Financial market. So the business and the financial manager in a business, the business is working with the market. So we have to understand the market. In our country, there is primary market. For example, nowadays, number of share companies are increasing. They are advertising to sell their shares, but there is no formal market, specific place to trade. There is no formal market, but there is kind of primary market. But once sales are issued, there is no place to trade. There is no secondary market. And there is a recent move to establish financial market in our country. We'll discuss about that. So we have to understand the financial markets. Financial markets. So when you see the goal of a financial market, the main advantage or the intent of this financial market is helping surplus units and deficit units to meet. So tax savings from who do not wish to consume, that is surplus units, and to channel them to those who wish to invest more than they have presently, or deficit units. When you say market, as I have said previously, it includes institutions, it includes instruments. There is place also, there are procedures, the process. But in our country, the financial market is dominated by institutions. There are institutions, banks, for example. It is dominated by banks. But banks are not the only means to access finance. And they are not the only means to invest too. The financial market, for example, let's consider this bank-dominated system, financial system in our country as a market. But banks are one active participants in the financial market. But unfortunately, in our country, the financial system is dominated by bank because there is no secondary market. That means if there is surplus unit, an individual or an organization with excess cash or wish to postpone current consumption, surplus unit, will deposit in a bank. That deposit will be channeled to deficit unit. Organizations or individuals having idea, investment idea, and that investment idea requires money more than what they have, so deficit unit. So the financial market will facilitate the flow of money. Tax savings from surplus unit, channel that saving to deficit unit. So the main advantage of financial market is this one. In our country, for example, if you are interested to establish, form a new business, or if we are already running a big organization, if we face shortage of cash, liquidity problem, for example, we have to go to banks. And banks themselves will have their own liquidity problem. So it is difficult to access short-term source of finance. Even as a policy, banks will not provide short-term source of finance, but there is some form, but that's not enough to do business. If we are interested to access long-term source of finance, we have to go to banks still, in our country's case. So whether to get or not will depend on their will. And even they are highly regulated, and the regulatory body will restrict the amount of finance that will be provided. So it is difficult to access finance to do business in our country. Even to invest, it is difficult because there is no market. To invest, we have to purchase shares, and there is no platform to purchase shares. There is no secondary market. So once shares are purchased, individuals will communicate by themselves. Otherwise, there is no platform to communicate. But if there is financial market, shares will be traded in the market. If I have money, small amount of money can be invested. You can purchase share of a big company by purchasing small share, by adding shares. Subsequently, we can be big investors. But in our country, it is difficult to do business by using small amount of money. For example, if you have 100,000 birr, it is difficult to do business. But if there is financial market, you can purchase shares. You can easily invest. So the financial market will make the financial flow smooth, will make investment and financing smooth, and it will contribute for the development of the country. So let's see types of financial market, but these are not the only types, but the main types of financial market and common classifications. Primary market, secondary market, money market, capital market, organized, over the counter. Many primary and secondary. A primary market, as the name implies, primary, for the first time. That means primary issue of securities are sold to investors. The issuer may be a government, maybe a bank or a corporation. For example, if there is a corporation, newly established corporation, that corporation will sell shares for the first time. So the transaction in this case is between the issuer and the investor. The issuer may be a government, bank, or corporation. The investor may be an individual, even a government, a bank, or corporation. Some organizations are issuers, some are investors. So simply primary market is a market in which securities are traded for the first time. The seller is the issuer for the first time. The buyer is the investor, issuer and investor. For example, there are banks under organization in our country. They are selling shares. This is, if there is a market, this sales activity will be performed in the primary market. Secondary market, as the name implies, allow investors to trade financial instruments between themselves. For example, once you purchase share, if we are interested to sell those shares, there is no platform in our country. Secondary market is missing in our country. And it is the largest market, and it will give us continuous pricing mechanism. Look, for example, in our country, there are big organizations established 20 years back or before 20 years. And there is no market. And how can we determine the share price of those companies? And for example, there are public organizations, public enterprises, and the government is trying to privatize those organizations. What is their price? And how can we determine that company's share price? Because there is no secondary market, there was no continuous pricing of shares. And in the world, there is no other mechanism. There is no mechanism other than the market that we can appropriately determine value. We can estimate some share price, but individuals' perception will not properly determine the appropriate price. So secondary market is a market in which securities are traded for the second time, or the third, fourth maybe. And there will be continuous improvement of share price. If there is positive information about the market, for example, about the company, sorry. For example, if the company identifies new projects, if that new project is going to be profitable, if this information is disseminated, the share price will increase, share price of the company. If there is negative information about the company, share price will decline. So there will be continuous improvement, continuous valuation of shares if there is secondary market. If there is secondary market, investment will be easy. If there is secondary market, financing will be easy, but there is no secondary market in our country. And as you all know, our country is one of the countries that is difficult to do business. So secondary, here simply understand what primary market means and secondary market. Primary market, initially issued securities by the organization will be sold to investors. Secondary, the transaction will be between investors. The transaction will be between investors. And if you have any question, please, you are welcome. If you have any question, you can ask. Okay. Let's continue. Money market and capital market, another classification of financial markets. These are sub-markets, by the way, in the financial market. These are sub-markets. Money market, Money markets are markets in which securities having maturity date of less than a year will be traded. When the securities, we are referring negotiable instruments like treasury bills, certificate of deposit. These are securities. Stock, corporate bond, government bond. These are securities. When I say security, well, I'm referring those financial instruments. Money market, a market in which short-term securities are traded. For example, treasury bill. In our country, for example, there is a government treasury bill. In Amharic, የመንግስት የግምጃ ቤት ሰነድ. They are short term, maybe 90 days, maybe 120 days. The maturity date is short. Certificate of deposit. Actually, to sell this certificate of deposit and others, we need a financial market. But certificate of deposit is another type of money market instrument. Simply, money market is a market in which short-term securities are traded. As a business administrator, we can work with a money market. For example, if your company faces shortage of cash, short-term cash shortage, you can borrow from the money market by selling securities, short-term securities. And you can settle that money after receiving your cash. So if your cash need is short-term, you can work with the money market. And if we have excess cash, excess current cash, you can invest it in the money market to generate additional return. So in business organizations, cash management must be effective. Cash management will be considered as effective if there is no shortage and if there is no too much excess compared with our current cash need. If there is shortage of cash, we are facing liquidity problem. We are not going to pay for input, so it will affect our company's operation. If we are holding excess cash compared with our current need, we are holding idle resource, and that shows management inefficiency. So if there is money market, if it has shortage, you can easily access cash. If there is excess cash compared with your current consumption, you can invest it and you can generate additional return within a short period of time. So money market will help business administrators or business organizations as a whole to manage cash. Capital market, when you say capital, the term capital refers to the long-term nature. So capital market is a market in which long-term securities are traded. Long-term securities. Their maturity is not within a year. For example, share. If we sell share, company share, the buyer will not expect repayment. Even the maturity is not known for shares. If we sell bond, usually 5 years, 10 years, more than that. Simply capital market is a market in which securities having maturity date of greater than a year will be traded. So if you as a business administrator needs finance for your new project, it is long-term project, or to construct building, it is a long-term asset, for example. You have to consult the capital market. You have to sell bonds or shares. Otherwise, if you need money to construct building, for example, assume the construction process requires 5 years, for example. If you access finance from money market, the maturity is short. So you have to pay that cash before constructing that asset. So it is difficult to operate in this case. So if your investment is long-term, your source of finance must be long-term. So capital market is a market in which securities having a maturity date of greater than a year will be traded. You as a business administrator will consult this capital market if you need long-term source of finance. Another classification of market, organized and over-the-counter or OTC market. Organized and over-the-counter. Organized market or organized exchange, as the name implies, it is organized. There is a specific place to trade, specific place or flow to trade. There is place. For example, like commodity market in our country, having a specific place to trade. Organized capital market will have a specific place to trade. By the way, when you see the difference between commodity market and financial market, in commodity market, as the name implies, commodities will be traded. In financial market, financial assets will be traded. The nature of the operation is somehow similar. And another difference is financial assets are sensitive and risky. It is highly risky compared with commodity markets. So here, simply understand what do you mean by exchange market. A market having a specific place to trade. There is flow. Flow of traders will be there. Over the counter or OTC market, usually OTC markets are secondary markets, and this is a market having no specific flow to trade. We can effect this transaction online, electronically, over the counter. So exchange market having specific place or floor to trade. Over the counter market, it is a market that buyers and sellers communicate virtually, electronically. So these are types of financial market. And next we're going to see principles that form the foundations of financial management. If they have any question, please. If you have any question, you can on your speaker and you can ask anytime. Okay, let's see principles that form the foundations of financial management. One is risk-return trade-off. At the time of these financial decisions, investment decision, financing decision, working capital, dividend, we have to know that there is risk and return trade-off. We will not take additional risk unless we expect to be compensated with additional return. Increase in risk, increase in return. We expect this. Otherwise, if there is an increase in risk and if there is no increase in return, we are not going to take that risk. So in doing business, we have to know the trade-off between risk and return. So investment alternatives have different amount of risk and expected returns. The more risk an investment has, the higher will its expected return. We have to know that. If we take high risk, we have to expect high return. Otherwise, if there is no high expectation of return, we should not take that risk. Risk-return trade-off is common. Another principle is time value of money. Time value of money. A dollar or a bill received today is worth more than a dollar received in the future. 1,000 birr today is worth more than 1,000 birr tomorrow or after a year. A dollar received today is worth more than a dollar received a year from now because we can earn interest on money received today. It is better to receive money earlier than later. We can easily receive interest by depositing that money in a bank. And if there is financial market, we can invest that money to generate additional return. So a money today is greater than a money after some time. So you have to know this principle. Another principle is agency problem. You as a business administrator or an investor, you can take different positions. You may be a manager in one organization and an investor in another organization possible. So in financial decisions and financial management in general, there is agency problem. Managers would not work for the owners unless it is in their best interest. In principle, in corporate type business, managers are agents for shareholders. They have to work in line with shareholders' interest. But sometimes managers will not work based on shareholders' interest. So this is what we call it agency problem. So the separation of management and ownership of the firm creates agency problem. So principals are far from the organization. Shareholders, principals. Managers, agents. So managers may take decisions that are not in line with the goal of maximization of shareholders' wealth. We'll talk about this. So will not work in line with shareholders' best interest. Agency problem. We have to know this as an investor or as a manager. Another principle in financial management is cash, not profit, is king. Cash is king. Cash flow, not accounting profit, is used to measure wealth. Cash flow, not profit, are actually received by the firm and can be reinvested. In modern accounting system, profit means revenues minus expenses. Revenues means the increase in net wealth as a result of rendering service or as a result of selling goods. But revenues can be recorded as revenues if performance obligation is satisfied. That means if it is a service giving company, for example, if the company provides service, regardless of its cash collection capacity, it is possible to record revenue. Revenue is recorded without collecting cash. So the revenue in the financial report is simply a number. It is a number. It's not actual resource that can be immediately used by the organization to generate additional revenue. Expenses, the same. It is possible to record expenses without paying cash. Once our company uses another company's service, for example, whether it is paid in cash or not, it is possible to record it as expense. So profit means revenues minus expense. So there is some number. That number is not actual resource for immediate use. But cash, when it is resource, readily available for use. So as a manager, as a business administrator, and as an investor, you have to see the cash, not profit. Especially as a manager, you have to focus on cash because you are going to use the cash, not the profit. Profit is simply a number. So cash flow, not profits, are king. Even cash flow for decision making, you have to see the incremental cash flow. The incremental cash flow. For example, if it is investment decision, you have two alternatives: accepting that investment or rejecting that investment. If you accept the investment, you will have incremental cash flow. So if there is no incremental cash flow, it's not appropriate to accept it. So even for decision making, when we say cash flow, we are referring incremental cash flow as a base for decision making. Decision making is simply choosing among alternatives. If there are different alternatives, and if cash flow is used as a criteria, you have to see the incremental cash flow. I think I'm not the administrator. Okay, now you are allowed to unmute your phone. Okay, continue. That's Fakiros.
Can I come?
Yes.
Can I come in?
Yes.
Okay, in the financial part, especially the treasury bill,
Okay.
what will be, I mean, is there any difference between interest and the return or profit from treasury bill?
To select the appropriate investment area. So your decision criteria will be the value adding capacity of that investment. Otherwise, both are returns for you. Is that clear? That's Kiros. Is that clear?
Yes, thank you, Doctor.
Okay, we'll discuss about risk and return later. Okay, if you have another question.
Hello.
Yes?
The difference between organizational exchange and capital market. What is the difference between two?
Organizational exchange and
Capital market.
When you say capital market, we are classifying market based on instruments traded. For example, there are company shares, there are government bonds, there are corporate bonds. Money market may be issued by government and companies. Their difference is the maturity date. Based on the maturity date of instruments traded in the market, we can class
Capital market and
capital market.
Organized exchange. There are two.
I'm coming to that. Capital market. Capital market is a market in which securities with long-term maturity date are traded. Organized and over-the-counter, it is the classification base is based on location. Based on location. Organized exchange will have a specific place, maybe house, to trade. So the market classification base is not the same. Capital market, the classification of the type of market is based on the maturity date of securities. Organized over the counter, the classification base is based on location. But in organized exchange, capital market instruments can be traded, shares can be traded, or money market instruments can be traded. Treasury bills and the rest can be traded. So organized exchange is classification of market based on place or based on the presence of specific place to trade. The capital market and money market classification is based on the nature of the maturity date of those instruments. Am I clear?
Thank you.
But money market and capital market instruments can be traded in exchange market or over the counter. Possible.
Thank you.
Is that clear?
Yeah, thank you.
Okay. If you have any question, another question. Shall we continue? Okay. So let's see another principle in financial management, that is efficient capital market. As a manager, we have to know that we have to assume at least there is efficient capital market. That means the value of all assets and securities at any instant in time fully reflects all available information. And at the time of deciding our investment, source of finance or capital structure or others, we have to know that this information will be reflected in the market. So the market is efficient. Both positive and negative information about our company will be reflected in share price. If the information is good, that means information about our company is good, this good information or positive information will be reflected in share price by increasing it. If the information is negative, it will be reflected in share price by decreasing it. This will be true if there is secondary market. So we have to know that the market is efficient. And there are different arguments, but at least we have to assume that the market is efficient. So we have to be careful at the time of disclosing information. And we have to know that there is competitive market. So arbitrage is not as such simple. It is not easy to get unlimited amount of return by investing in some area because there is curse of competitive market. There is competitive market, there is efficient capital market. So it is difficult to manipulate the market. Unless we are a monopoly, it is difficult to get unlimited amount of return. So it is hard to get exceptionally high profit from a project. We have to know that. We should not expect this. We should not expect to get unlimited or unexpectedly high profit from our investment. We have to know and we have to consider the presence of competition, and we have to know the presence of efficient capital market at the time of financial decision making, the time of investment decision and others. Another principle, tax affects business decision. So we should not ignore the effect of tax. So at the time of investment decision, for example, different areas of investment will have different tax rate, and different forms of business will have different tax rate. If we are investing in different countries, different jurisdictions, tax in different jurisdictions will be different. So tax will influence our investment decision. We should not ignore that. For example, there is 40% corporate tax in our country. And there's also tax on dividend, 10% tax dividend. But if it is sole proprietorship, for example, there is no double taxation. There is no double taxation. So the form of the business, the area of investment will lead to different tax rate, and that tax rate will affect our business decision. So in financial decisions, we should not ignore the tax effect. Within some countries, the corporate tax rate is 40% or 50% even. So it is too high. So it is one critical component in financial management. And another issue that I have to know is all risks are not equal. At the time of financial decision, we have to know that all risks are not equal. For example, at the time of investment decision, we have to know that some risks can be diversified, some cannot be, or systematic and unsystematic risks are there. For example, if the risks are company specific as a result of poor management, for example, we can diversify this type of risk by investing in different organizations, by purchasing share of different organizations. We can diversify company specific risks. But usually macroeconomic risks would not be diversified, systematic risks. So at the time of investment decision, we have to know that there is risk, and we have to know that those risks are not equal. Some are diversifiable, some are not. And another issue in financial decision is the presence of ethical dilemma. You as a business administrator, at the time of financial decision, you will face ethical dilemma, the difficulty to decide the appropriate act. So ethical behavior is doing the right thing, and ethical dilemmas are everywhere in finance. Each person has his or her own set of values, which forms the base for personal judgment about what is right thing. So sometimes we'll face a difficulty to decide which one is right. A dilemma, whether to invest in some areas, whether to reject investment in some areas. We'll face ethical dilemmas. So at the time of solving those ethical dilemmas, we have to avoid rationalization of our unethical behavior. So we have to be careful. It is common in accounting and in finance and doing business in general. You will face ethical dilemmas. For example, sometimes there will be profitable project. That project will harm the society in some way. So that project will have advantage for the society in another way. So in this case, we'll face ethical dilemmas, whether to invest or not. At this time, you have to be neutral and professional. You have to avoid rationalization of your unethical behavior and try to solve it in a less harmful way. But which one is the appropriate way? We don't know. Only the individual or group of individuals in that position will decide. But the main thing that you have to do here is avoid rationalization of your unethical behavior. And commonly, individuals rationalize their unethical behavior in three ways. One is everybody is doing it. If you believe like this, you are telling yourself that that action or harming others is common. If you believe that everybody is doing this business and everybody is investing regardless of the investment's harm to the society, you will act inappropriately. So avoid rationalizing your unethical behavior. And sometimes individuals and business try to justify their unethical behavior by saying that if it is legal, it is ethical. That means if there is no clearly stated law about that thing, they will assume that that activity is legal and that activity is ethical. That means considering law as a perfect instrument, but law is not going to be perfect. So if we assume that if it is not clearly stated in the law, we are ethical, we'll act inappropriately. So we're not going to solve ethical dilemmas in a neutral way. So avoid this kind of thinking. Another way of justifying unethical behavior is the probability of discovery. If we assume that the business will harm the society, but it will not be identified by some individuals or the regulatory body, will act inappropriately. So avoid rationalizing your unethical behavior at the time of facing ethical dilemma. Try to be neutral and try to choose the appropriate act, the act that will have minimum effect. So which one will have minimum effect? We don't know, because everyone will have his or her own values, set of values. So know that the presence of ethical dilemma is common in financial decisions, but you have to be careful in solving those ethical dilemmas. If you have any question. If you have any question. Okay, another issue that we'll say here is goal of financial management. Goal or a decision criteria. That means, for example, there is investment decision. What is our decision criteria? What we are going to achieve by that decision? Goal. There is also capital structure or financial decision, working capital, dividend. What is our ultimate goal, or what is our decision criteria? So what should be the goal of a corporation and financial management in a corporation as well? We can cite different goals of a corporation. Maybe profit maximization, cost minimization, and maximization of share price, maximization of current value of company's share or stock can be considered as a goal of a corporation. But the commonly cited goal is profit maximization. Profit maximization. If we say profit maximization as a goal, an action or an alternative that will increase profit of a firm should be undertaken. For example, as time of investment decision, if the profit is high, we can select that project. If there are multiple alternatives. If we set profit maximization as a criteria, a project with higher profit will be selected. Okay. And an action that will decrease profit should be rejected. So if we say profit maximization as a criteria, an action that will increase profit will be selected, an action that will decrease profit will be rejected. Okay, so profit maximization as a criteria will be like this. Action that will increase profit accepted, action that will decrease profit will be rejected. But it has some limitations, limitations of profit maximization. One is ambiguity. It is ambiguous, it is not clear. The term profit or income is vague and ambiguous concept. If we set vague or ambiguous goal, we are not going to achieve it. So it is the first limitation, ambiguity. So different people understand profit in several ways because there are many different economic and accounting definitions of profit. Profit, does it mean an absolute figure presented in birr or dollar or rate of profitability? Is that total profit in birr or total profit compared with total investment rate? They are different. Does it mean short-term or long-term profit? Does it refer to profit after tax or before tax? Net profit for ordinary shareholders or common shareholders or net profit for total investors? It is vague. Then the question or the problem would be which profit is to be maximized. It is vague. So if we say vague goal, we are not going to achieve it. Another limitation is it could increase current profit while harming the firm's future survival or solvency, you can call it. If we set profitability as a criteria, we can achieve that profitability by harming the future survival of the organization. So business might increase short-term profit at the expense of long-term competitiveness and performance of a business. That means if we set profit maximization as a criteria, our main activity is maximizing profit. There is a proverb in Amharic, kind. Whenever there is an activity that will increase profit, it will be accepted. Whenever there is an activity that will decrease profitability, it will be rejected. So the company will be short-term oriented. Short-term oriented. For example, cutting discretionary expenses that will be determined by the management judgment, like research and development expenditure. If we set profit maximization as a criteria, we can cut research and development expenditure so that our company's profit will increase, because profit means revenues minus expenses. So if we cut discretionary expenses, we can maximize profit. We can achieve short-term goal. But if we cut research and development expenditure, there is no innovation. Innovation will decline. And we're not going to be competitive. So the future survival of the company will be under a big question. We can postpone, we can defer or postpone important maintenance costs. We have to maintain machineries so that those machineries can be efficient, but to minimize expense, we can postpone maintenance. It will have negative impact in the future performance of the company. Setting of training and development. We can minimize expenditure so that we can increase profitability, but it will have negative future implication. If individuals are not trained, innovation will decline, efficiency will decline, it will affect the company's performance in the future. Or buying lower quality materials, cutting quality cost mechanisms, simply quality cost mechanism cutting, it will have disastrous effect. Quality cost in organizations is critical, especially cost incurred in conformance conformance. That means we have to set mechanisms to make sure that our product meets the specifications. There will be testing, machine, giving training for employees about quality and others. These are quality costs. But if we cut quality cost, and if defective product is sold to the market, the impact will be disastrous. The best example for this is Boeing. You can remember it. Boeing's case. The defect of the product is identified by users. And you remember what happened to Boeing. Non-conformance cost. If we cut internal mechanisms to maintain quality, the defect will be identified by users, and the impact on the company's performance is disastrous. If we set profit maximization as a goal, will be short-term oriented. And being short-term oriented will affect the future survival of the organization. So this is another limitation of setting profit maximization as a goal. So these policies may all have beneficial effect on short-term profitability, but may undermine the long-term competitiveness and performance of the business. Another limitation of profit maximization is it ignores time value of money, timing of benefit. As I've said previously, the money today is worth more than the money after some time. But profit maximization criteria ignores the difference in the time pattern of benefits received from investment proposals. So profit maximization criteria doesn't consider distinction between returns received in different time periods. That means the profit maximization goal will treat money today as the beginning of the year and money received as the beginning of the year and money received as the end of the year as if they are equal, but they are not. This is another limitation. Let's see it by using an example. For example, a BC company wants to choose between two projects, and project X and Y. Both projects cost the same. Their cost is the same, and they are equally risky and are expected to provide the following benefits over 3 years. You can see the total benefit is the same, 75-75 for 3 years, but the timing of return is different. Project X, 25 in the first year and 50 in the second year. Project Y, 50 in the second year and 25 in the third year. Which project is good? Which project is good? If assume they are mutually exclusive, you have to select one. Which project will be selected? Is there anyone who can tell me which project is good for you? Their return is the same. Assume they are mutually exclusive. Okay, Sintayo. Okay, I can't hear you. Continue.
Thank you. Can you hear me now?
Yes, yes.
I think Project X is better than Project Y because we are getting the benefit 25,000 this year, so we can reinvest that money for our operations. Of course, at the final term, we get equal benefit from both projects, but in case of
yes, you're right. We can generate additional return by reinvesting it.
Yes, yes, sir. Thank you.
Yeah, good. That's good. But if we set profit maximization as a criteria, the timing of return will not be considered. So both projects will be treated equally. If we set profit maximization as a criteria, there is no consideration of time value of money. But as I've said, as Ntayo said, Project X is better than Project Y because the return of Project X in the earlier years, so that we can reinvest it. Return of Project Y, later years. So time value of money concept this year. But since there is no consideration of time value of money, both projects will be treated equal if we set project profit maximization as a criteria. However, X provides higher benefit in earlier years and Y provides larger benefit in the latter years. So X is better than Y. But profit maximization as a goal will treat both equally. And profit-seeking organizations must consider timing of cash flows and profits because money received today has higher value than money received tomorrow. And cash flows in early years are valued more highly than equivalent cash flows in later years. So it is not advisable to set profit maximization as your organizational goal. And most of the time, if we ask individuals about, business organizations about their goal, they will say profit maximization. But profit maximization has these limitations. Another limitation is it doesn't consider quality of benefits. Risk will not be considered. Profit maximization assumes that risk or uncertainty of future benefit is of no concern to shareholders. There is no risk considerations. If there are planned projects, if we set profit maximization as a criteria, there is no consideration of risk, so projects will be treated equally. We'll say it by using an example. When I say risk, it is defined as probability that actual benefit will differ from the expected benefit. Deviation from the expected risk. Profit maximization as a decision rule, as a goal of an organization, will not consider the quality of benefit or the risk associated with the benefit. So financial decision making involves this risk-return trade-off. This means that exchange for taking greater risk, the firm expects higher risk, as I have said previously. Risk and return are usually associated. We should not take risk unless we are going to be compensated for taking that risk. Let's see it by using an example. XY company must choose between two projects. Both projects cost the same. Project A has 50% chance that its cash flows will be actual over the next 3 years. Project B has 90% probability that its cash flows for the next 3 years will be realized. The projected cash flows are given. The probability of getting those cash flows given. Their initial investment is the same. If you set profit maximization as a criteria, which project is profitable? Is there anyone who can tell me this? Which project is profitable? If we are in a position to decide, and assuming both projects are mutually exclusive, if you accept one, you have to reject the other. Which project is appropriate to finance? Is there anyone who can tell me this?
Can I come in, sir?
Yes.
It's Sentayo.
Yes, continue.
Based on profit maximization criterion, it's
I can't hear you.
hello. Can I?
Yeah.
Are you listening me?
Continue now. Yes.
Yes. Okay. Based on the profit maximization, we will take project A.
Because
we only consider the data.
the total
We will not consider the future effects.
Will not consider the risk or the probability of getting.
Yes.
Yeah.
We only
So
take
the
the figures.
figure.
Yeah.
So since there is no risk consideration, all right, we'll see the total figures.
Yes. If we take the risk, we consider the risks, we will select project B because it has high probability of getting the cash flows.
Yes.
Thank you.
Thank you very much. So if we see if we set our company goal as a profit maximization, project A will be selected because the total return is 220. Project B's total return is 180, and as it is said, the initial investment is the same. So project A looks better than project B. But if we consider risk, the probability of getting project A's return is 50%. And the probability of getting project B's return is 90%. So when you see the expected return, return times probability. Look, expected benefit or expected return of A is 220,000 times 50%, it will be 110. The expected return of project B, 180 times 90%, it will be 162. So project B's expected return is higher than project A's expected return. But in profit maximization goal, since there is no consideration of risk or quality of return, we will see simply the total figure and project A will be selected, and it will harm the organization. So this is another limitation of profit maximization as a goal. So the more certain the expected cash flows or return, the higher the quality of benefits or low risk to investors. Conversely, the more uncertain or fluctuating the expected returns, the lower the quality of benefit or higher risk to investors. So this is another limitation of profit maximization as a goal. The other one is it doesn't show cash flow available to shareholders. Simply total profit figure will be presented. So profit doesn't represent cash flow available to shareholders. Total profit, as I've said previously, profit and cash flows are not the same. Accounting profit, revenue minus expense, and cash flow are not the same. When we say cash flow, we are referring to the actual cash received by the company minus the actual cash paid by the company, net cash flow. But if we say profit maximization, we'll say total accounting profit, net income. But that net income is simply a number that's not going to be used by managers, or that's not the amount that will be paid to shareholders. It is simply a number. So it doesn't show cash flows available to shareholders if we say profit maximization as a goal. So above all, accounting profit is affected by accounting methods used. The amount of net income will be different if we follow different accounting methods. I'm not going to talk about accounting, but for example, there are different ways to value inventory under the current accounting standard. And there are different ways to treat assets, to value assets. So different accounting methods will result different amount of net profit. So this is another limitation of the profit maximization as a goal. So the goal of a modern organization is wealth maximization, and it should be. Wealth maximization. It's the contemporary view of goal of the firm, wealth maximization. Wealth maximization means maximization of the value of the firm, maximizing the firm's value, or maximize the economic well-being or wealth of owners, and it will be reflected in share price. Maximizing share price. But unfortunately, there is no financial market in our country, and there is no continuous valuation of shares. So the goal of many business organizations is to maximize profit, and it is defective. Profit and wealth are not the same. The company's value is not simply the annual return. The company's value is more than that. There are many intangible resources for that company. But in our country, those things are ignored. And because there is no continuous valuation of shares, because there is no market, and it is difficult to get share price. We don't know the share price of a company established 20 years before. We don't know the share price of Ethio Telecom, for example. We don't know the share price of other public enterprises because there is no secondary market. So the goal of a modern organization must be maximization of wealth. Wealth maximization will be reflected in share price. We can reduce this goal to maximizing share price because every reaction or every decision in the organization will be reflected in share price. If our investment opportunity is good, positive effect on share price. If it is not, negative effect. Source of finance, every decision will be reflected in share price because there is efficient market, and there is competition, everything will be reflected in share price. So the goal of a modern organization is maximizing wealth. Wealth maximization will be reflected in share price. So it considers time value of money concept. Simply wealth of a company is present value of all the benefits minus present value of all the costs. So we'll see time value of money concept in this chapter, so that it will be more clear. So the goal of a modern organization is maximizing wealth, not profit. And this is a formula to calculate present value. We'll see it in detail at the time of discussing time value of money. It will be more clear. For example, share price will be dividend divided by 1 plus discount rate. Dividend, money that will be received after some time, that is the future value, divided by 1 plus discount rate will give us the current value of that dividend. This is time value of money concept. There is a separate section about time value of money, and we'll discuss it in detail. So now, simply understand that the goal of a modern organization is maximizing share price. So every decision in our organization must be in line with this. So share price maximization will be used as a decision criteria. Okay, we'll see the remaining part of the chapter in our next class. I think this is enough for today. If you have any question, you can ask. If you have any question. If you have no, thank you. This is all about today's class. We'll meet in our next class. If there are any changes, I'll communicate with the representatives. Thank you.
Thank you, Doctor. Thank you.
All right, thanks so much.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።